Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing the danger of chart hopping. One of the biggest areas where new traders fall down is chart hopping. They flip from one chart to another looking for the opportunity which will give them a chance to bag a couple of hundred pips. They do this without fully appreciating all of the dynamics involved in technical analysis. They think they spot a trend and jump right in and execute a trade thinking only of the money they could make. They often make the mistake of buying at the top of the market or selling at the bottom. They think they may have spotted a trend, and perhaps they have, or it might be that some news has just come out and they make a split-second impulse decision to buy or sell a currency pair simply based on what they've seen or heard. Although they may indeed have spotted a nice trend, it could be that the trend is about to stop dead in its tracks and turn. Such traders will not even bother to implement the most basic of technical analysis. This sort of trading is tantamount to gambling. Do not execute a trade until you have backed up your theory with a tried and tested technical analysis methodology. So when are trends likely to end? Why do they reverse or go into periods of consolidation? Typically, trends will start to fade and finish at the end of trading sessions, such as the end of the Asian, European, or US sessions. Those traders have been buying or selling a pair based on their trading needs or beliefs pertaining to the market conditions, or possibly due to their balance sheet requirements, or even because they are influenced due to their own country's import and export requirements. They may have seen a good trend and jumped on it, but when the session came to an end, they closed out their interest and took their profits. It might be that they are also rebalancing their portfolios by getting in and out of positions to cover market volatility in risk-on and risk-off scenarios, where the sentiments of one session which is ending may be completely different to the sentiment of those traders coming into a new session in a new country where they have their own various sets of requirements and beliefs about where currencies should be in relation to one another. Of course, it could be that trends fade for no apparent reason. It might come to the end of a 15-minute candlestick or an hourly or daily candle, which is enough to tip the balance and reverse a trend. It could also be that a pair is deemed to be overbought or oversold due to technical analysis. Impending economic data releases is also another time where trends can stop for no apparent reason, or around the times where key policymakers are due to make policy statements or speeches. One critical mistake is where traders will hop onto a trend, which is absolutely great if they have done their homework and all of the above mitigating circumstances are taken into consideration. But they may not have factored in that perhaps a currency pair has already moved a couple of hundred pips, in which case it is quite dangerous to jump onto a trend and expect that to continue without some kind of pullback. Our advice is not to make impulsive trades based on hopping from one chart to the next. Always do your technical analysis research and make sure your timing is correct and that you have considered all of the above before you execute a trade. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.